Hi, I'm Ryan Lightfoot-Brown, research analyst at Chelsea Financial Services. We're joined today by Matthew Page and Ian Mortimer, managers of the Chelsea Selection Guinness Global Equity Income Fund. You use screens to eliminate some companies from your universe. Can you explain to us how that works and how you use that?
Sure. Well, the first thing we really wanted to do was to look for high quality companies. Running a dividend fund, the temptation is to go and look for high dividend yield, but we didn't want to start by looking for dividend yield. So instead, we take a screen that looks for companies that have consistently achieved very high levels of profitability for every year for the last 10 years. And there aren't many companies in the world that achieve this level. So around 500 companies out of maybe 16,000 that are listed around the world achieve that target. And we also want to see a strong balance sheet. So we look for a debt to equity ratio of less than 1 and a market cap of over $1 billion. And that really defines the pool of companies that we're going to select our portfolio of 35 companies from.
Great, thank you. Now, when you've found these funds, you buy them in the same weights, so equal across the funds. Can you explain the rationale behind this?
Yeah, sure. So when we run the fund, we have a 35 stock portfolio, so we're quite concentrated in what we do. And as you say, we equally weight them, so all our positions are around 3%. The reason we do this is for a number of reasons. I think the first thing for us is, though, it instills quite a strong sell discipline. So one of the things we have to do if we're finding new ideas is think about what we should sell to make way for that new idea. So that means we're always thinking about what we own, and we're always trying to keep our portfolio fresh.
Great.
I think what it also does as well is it limits stock-specific risk. So what you'll never see in our portfolio is very, very high weights in single names. And similarly, on the other side, you'll never see a long tail of small positions that we've forgotten about. So that means we're trying to sort of use market movements to top up things that may be underperformed, at the same time trim things that have actually outperformed a little bit. And therefore, that's what we think is a sort of sensible way of constructing a portfolio.
Okay, brilliant, thank you. And have you got an idea each of new opportunities you're seeing coming through?
Yeah, I mean, I think when we look through our universe of these 500 companies at the moment, I think the things that are jumping out at us is that the value opportunities today are more in the cyclical industries than they are some of the more defensive industries. And I think when we look geographically, we're finding maybe more opportunities in Europe than we are in the US. And we've certainly been adding a few names to Europe and Asia over the last 6 months or so. The one sort of counter to that would be, I would say, we are starting to see more healthcare companies reach attractive valuation points after the failure so far of the Trump administration to revoke the Obamacare policy.
Yeah, and I'd say we're an equity income fund, so we're looking for companies that pay dividends. And really, what we're always looking at is we're not trying to invest in high dividend-paying companies. So our focus is always on dividend growth, and I think today's market that's quite important. If we've got interest rate rises, equities or assets that pay high income can be affected more by that. So we protect ourselves a little bit on that side. And also, what we see is dividend growth is actually quite well correlated to inflation over the longer term. So that helps you sort of protect if you're using that income to draw down, if you like, or use that to live. Then that will help you protect a bit and keep your spending power, if you like.
Brilliant. Well, Matthew, Ian, thank you very much for coming in.
Pleasure, thank you.
Thank you.